Hello and welcome back to All Things Money. I'm your host, David Blain. And during this segment, we're going to wrap up about some of the issues going on in the annuity market. And one of the reasons we don't recommend people get into that. We'll also talk about what's going on in the market. But before I do, just want to welcome all our viewers and listeners out there on 94.1 FM WNBU as well as cable TV 10 in New Bern. We'd also like to thank Bob Register, our engineer for the show, and all you streaming the show from the internet. We appreciate each and every one of you. For those of you local, I see you around town, and I just love, being out at a restaurant or something and have people come up and say something. So we enjoy engaging this. This is what I do for a living. I live, eat, and breathe it. And so if you have any questions, certainly give us a call. But when I see you around town, don't be afraid to ask me about it. People generally do, but I enjoy talking about it all the time. Okay, so during the first segment, if you missed it, head on over to our website, dlblain.com. You can pick it up there. But I was talking a little bit about some of the issues in the annuity market, and we'll just kind of wrap up here to say that, in the mid-2000s, annuities, variable annuities were really the hot type product. And insurers sold these products with these huge, massive guarantees on them. And then when the financial crisis hit, they said, whoa, wait a minute, what in the world did we promise? And the regulators came in and required them to beef up their capital structure because here's the secret, there was no way in the world they were going to be able to meet these guarantees. And that's the problem when you buy the annuity, is you're relying on a guarantee of an insurance company. So anyway, so they've come out recently and they've taken away all these generous benefits and from the marketplace. And for people that have the current annuities, they've either raised the fees, cut down choices, and in this last thing here, they're making people move their investments around to what they want. Okay, enough on that. The markets, the past, 4 to 6 weeks, some people have been getting very nervous. For those of you recent investors, maybe you've never invested before, or maybe you got scared and jumped ship during the financial crisis and have just been, got back in the markets maybe last year. Well, this is the first time you've seen that things actually go down. The stock and bond market, they do. They go up and down. As we've chronicled many times on this show, I've written many papers about it. Bear markets are a necessary evil. It's required in order to make the higher returns of close to 10% compounded annual return since basically we've been keeping records of the markets. So it's required that every so often it's sheer terrifying. It's kind of like, I hate to use this analogy, but it's kind of like a roller coaster. A roller coaster would not be any fun. Well, look at the kids' roller coaster. It just kind of goes along and, okay, it's a nice little ride, whatever. But most people go on a roller coaster ride for the thrill. It's required that, your stomach feel like it's going to come out your head when you go down that big drop. That's how they generate the thrill of, of a roller coaster ride. Well, when you're investing, how they generate the higher return is you have to go through some pain and agony. It's just the bottom line. If you aren't willing to take any of that, you're not going to receive higher returns. So what we've seen is since I believe it was maybe mid-May, we saw the 10-year Treasury yield at about 1.6%, lowest level we've seen in forever. And today or yesterday, the Treasury yield was up to about 2.5%. And so we see this big spike in interest rates caused by Bernanke, and we see some issues in China. Every day it's one thing or the other. Well, anyway, I've talked about this before sometimes, sentiment. Sentiment is the sort of the psychology of the market, psychology of investors, and there's a number of ways to measure it. One of my favorites is something called the Ned Davis sentiment indicator, and Ned Davis Research is a very expensive research service that institutions, in fact individuals, can't subscribe to it. And there is a point to this. I don't want to just tell you about something you can't subscribe to, but so we've subscribed to that, and they have a lot of good information, and they have this sentiment indicator that it's just a great indicator that shows when people are getting over enthusiastic and when people are becoming over fearful. And you can pretty much track, when people are getting over optimistic, they have a reading that essentially goes between 0 and 100. And anything over 65, 70% is considered over optimistic. And sure enough, as that gets up there and over optimism, you'll see the market start to tank. And as the optimism drops below 30 or so, back during the financial crisis, the thing got down to like 15 or 16. Generally is a great time to buy. Now, for a long-term investor, somebody that actually cares about taxes, transaction costs, or earning a rate of return, we don't recommend timing the market at all in terms of getting in and getting out. There's nobody, no hedge fund, no Warren Buffett, no guy sitting in his home in his basement in front of his computer day trading. There's nobody that has been able to consistently and reliably time the market, get in, get out, and exceed the return of holding a well-diversified portfolio. It's just a fact. It's a fact. There's nobody that's been able to do it. Sure, over short periods of time, you go back in history, there are famous people. I can't remember the names right now, which should be a good clue, but I have studied people that, I know, Joe Granville. He was a legendary market timer back in I think it was the 70s and 80s. And, he got this call right, and he was just, and then, of course, the whole system blew up. Back in the tech bubble, there was Henry Blodgett, he was making all these great calls, and then, of course, he blew up. So there's no proof of anyone able to reliably do it. So when I talk about the sentiment indicator, it's just more to give you comfort about what's going on in the market, not necessarily to run out and buy and sell. It can be used to help tailor your purchases. Anyway, well, that's coming up to a second break. When we come back for the final segment of the show, we'll continue talking about investor sentiment and maybe what you can do to help.